Very cool.
Awesome. Yeah, if you do see that poll pop up, feel free to fill that in. Would love to know where you guys are listening to this webinar and watching this webinar from.
Yeah, cool. Thanks for everyone who's done that. It's about half from Queensland, about 20-something% from Victoria and New South Wales each, and a couple from the other states. So yeah, sweet. All right. Awesome. Well, we might actually, the good thing about this is it's federal level. It's not state-based like some of the flood things and bits and pieces. So nice and straightforward. Before we get stuck into the budget update, I'll just give a quick heads up on things we've got popping up soon. So we've got the tax planning webinar for 2022 financial year, which, hang on, stop sharing that thing. So the tax planning webinar is coming up on Thursday, the 7th of April, which is, just over a week's time from now. The registration link for that one is in the chat box. Thank you, Tay, from our team for posting that one. If you're keen to join along, what we'll be doing is discussing, what business owners need to consider, and even things with SMSFs, self-managed super funds, and that sort of thing before the end of the financial year. There are a few extra things that are curly ones this year. We'll kind of mention them. I did actually put some of those recent ATO clarifications in the slides today to talk about. Just pop around this way, please. So we will be going through that for tax planning 2022, all on the webinar in just a week's time. And that will be, I think, myself and Riz again.
Yeah, sweet. And the key there is, you move past it, but that's okay. The 3 months is a key thing as well, guys. If you're not, this is a time we should be talking about this stuff. I highly recommend attending it. There's only 3 months left of the financial year. Let's win some. Let's make sure we get some wins with the ATO and the tax office this year.
Dear. That's it. Also, if you currently are wanting to talk more about what we talk about today, or have a conversation with one of our accounting team, then we invite you to do that through booking a strategy call with one of our accountants. Now, you can do that over the phone or even over Zoom, where we've just added that option now. I think a bit too late, but it's actually a better way of hanging out with people, asking questions and all that sort of stuff. So if you do want to consider a conversation with one of our team, please book that in using the strategy call link, which is in the chat box. And just a quick intro to the panelists and presenters today.
We got Ben Walker. I'll introduce you, Ben. So Ben, we've got Ben here. You might have seen him on other webinars as well. Ben started Inspire when he was 23. There's actually a cool podcast you can listen to his journey that recently we finished. There's a full journey story about how he started Inspire. He's an award-winning chartered accountant. Has worked in both big corporates and also in suburban firms, and now his own kind of show he's running here. And also he has 13 years of accounting experience and wrote the Cashed Up book as well. Something that's not there as well. He loves some really good Indian curry. So if you have any recommendations for some good Indians, even if in South Australia, please drop that in the chat box. So that's a little bit about Ben.
Thank you, Riz. You made me nervous. You know me too well. I didn't know where that was going, but anyway, and I'll reverse it here and introduce you. So Riz, or Rizal Ramzan, is all the way from Malaysia, where he grew up, and he's an associate partner, general manager and chartered accountant here at Inspire. He joined in 2016 after a bit of a few years in a couple of different firms around Brisbane before deciding to join Inspire, which has been fantastic to see him grow. Just as a client base alone in 2021 financial year, so this is last tax planning season, he saved $2 million just with his client base alone, which is pretty exciting. And we've also got Jamie, who maybe just pop your camera on again, Jamie. Jamie from our team is a senior accountant who was posting all the budget updates last night on our team Slack channel, which was cool. And definitely has his head around it for just to help our team get on the front foot with it. He joined Inspire in 2019 after coming from one of those those big four corporate machines, and played a hand in saving one of our clients $96K in tax, which is a huge amount. Jamie is an awesome dad to a beautiful girl, and you even mentioned a name there, Luna, and husband to a lovely wife, Chris. That's very cute.
And we've got other people on the team as well today that you might see the little kind of screenshots. They've got Rose, Glaze, and Tay, who will be helping us with the logistics. And they've worked really hard with setting this up today. I really want to thank them at the start. And hopefully we can have a smooth ride today.
That's it. Fantastic. Well, I mean, we've talked a lot about the tax savings already, but our team are about to enter in our next season of tax planning. To date, we've saved our client base over $18 million of tax and counting, which is pretty impressive. We love the ability to do that and the impact that has on our clients' lives. So that is a bit of an intro to the presenters, Inspire, if you don't know of us already. And now we might switch gears into the old budget update.
Yeah.
Alrighty. So in terms of the budget update, I've got kind of two slides on what we're going to cover and things to keep in mind first. So we're going to cover the type of clients we work with, which are small business owners. A lot of those clients actually have self-managed super funds as well. And we also look after some investors. You can actually be all three of those too. So it's a very, what's the word? That is the people we work with. And so that is the most relevant pieces of the budget we can take out and share. So that's the lens we're looking through. Now, in terms of every budget, there's plenty of fine print. We've got 4 dot points per thing that the budget's announced. Behind that might sit tens of pages of stuff, and it's all an idea anyway. So it's only it's only a draft until the legislation's actually passed and it's ready to go. So the other thing as well is we've mentioned the stuff worth mentioning. So there's more to it, but here's the key stuff. For instance, the Medicare levy surcharge thresholds changed by $80 or $100 for a certain income range. We're not going to go into that detail because it's just so menial and silly to waste pages over just something that has little to no impact on Australia, but definitely on our client base. So that is to keep in mind. Riz, would you like to explain the 420?
So the 420. So it's really interesting because this one impacts everyone. So you might have seen this in the previous years where they're talking about this one. It's such a peculiar number. It's 1080, $1,080 in tax offsets. That was in the prior years. This year they're increasing that by $420. They're calling it the cost of living tax offset, just to help out the average Australian. What it means is if you earn less than 125,000 or 12599 there in taxable income, you're going to get automatically a $420 tax offset. Now, it's not a tiered. It's not the more you earn, the less offset you get. It just goes from 420 to 0 if you exceed 125 grand. So we put everyone at the top there. Maybe not everyone, but it's most people are going to be handed out this $420 tax offset. Now, how does a tax offset works? It's essentially you get that as a tax offset against your tax payable for the year. So when you do your tax returns at the end of the year, it's not like you get that 420 in cash suddenly out of nowhere, but it adjusts the tax payment or refund when you lodge your tax return. It's definitely a sizable amount if you want the kind of the 45 to 60 grand range, because you're going to get $400 extra in cash this year, which is really, really good. So
might fill up the tank, mate.
Sorry?
Might fill up the tank.
I think it depends who it's for, and I think it's great. And something to note about this one as well is they're not looking to extend that into the next year. It's actually finishing by the end of this financial year, so 2022. But they're giving one last final boost before we do that. Now, there is a low income tax offset. So this is what we call the low to medium income tax offset. There's a low income tax offset as well that you get. Obviously, it's up for low income earners, that one. So the middle range, this is the last financial year that we're going to see that.
And then this is a bonus on top of that, 1,080. Yep. Cool.
That's right.
Wunderbar. All righty. Next one here, which actually helps with the filling up the car. But so this was kind of exciting to read, but the fuel excise is currently sitting around 44.2 cents a litre, which is like excise tax that the government adds on, which is... I didn't realize it was such a significant portion when, let's say, the fuel price is about $1.10 or $1.20 a litre. That was maybe a few months ago. But and sorry, just a side note, Lloyd, there will actually be a recording on this one. And even, sorry, just a side note, we're going to pop this as a budget special on our podcast as well. So the audio recording as we go. So yeah, enjoy that one. Alrighty, so the temporary reduction is going to be, they weren't really specific on this, but at least 22.1 cents per litre, which might take the edge off. That might drop the per litre price by about 10% at the moment. And who knows, the price of oil might come down as well. Or I think it already has dropped since it spiked. But anyway, hopefully we see more pressure taken off on the commutes, and thank goodness for the old working from home.
Yeah, and I think just to add with this one is how it works is it's a reduction in excise. So it's not like the the government's going to go into every fuel station and say, hey, cut your prices down. What they're charging those people are going to reduce. So hopefully that passes on to the consumers. So they've said that the ACCC are going to be the watchdogs to make sure that, that savings actually makes it to the consumer, not to the pockets of the server owners, essentially. So yeah, I think it helps a little bit of that, reducing that pressure. I feel like living costs is slowly creeping up. Everyone's feeling it a little bit, but yeah, that will help massively. Thanks, Ben.
That's it. All righty.
Cool.
Your favorite?
Not really my favorite, but it's something worth mentioning. Well, some of the small things is you can tax deduct COVID tests needed for work. So I've seen in instances where it can be quite disruptive to business owners if someone has to kind of get a test and get it done, and have to take some time off to do it. So I've seen where business owners actually buy some tests to keep at the office on behalf of the employees. So they're kind of giving it out essentially. So you can tax deduct those COVID tests as well. And there's small, like what Ben mentioned before, there's some small changes in the Medicare levy threshold as well. What that means is where you pay a premium on not having insurances actually changes a little bit. So it's not a big movement at all, but just worth mentioning.
Yeah. There you go. And I think even that tax deduction is for employees as well, from memory.
Yep.
The eligibility. So cool.
Yeah, if you're an employee watching or listening to this, if you bought one for work purposes, that's what I've been saying. It's tax deductible on your end as well. Beauty.
All righty. So we're going to shift into the small business section, which is actually one of the largest here. But we'll go through each thing one by one. The first thing is the skills and training boost. Now, I said that when Riz and I were sort of talking before we kicked off, there's not much happening. It sounds nice. It sounds cool. But at the end of the day, I've kind of worked out that it's actually not a huge amount that's going to help. So I don't know how I feel about it. But anyway, so the key things are it applies to expenses from budget night until the end of June, not this year, next year, but the year after. So 2024. So this is a few years you've got to use this one. It's for businesses with turnover less than 50 mil. And what it is you can deduct an additional 20% of the expense. So that's a tax deduction. That's not a tax offset or refund of 20% of the expense. It just further reduces your taxable income by 20% of the expense. So I'll just duck down to that bottom dot point there. So assuming that let's say you're at a company tax rate, a small business company tax rate of 25%, this reduces the expense by 5%. Like that's the net reduction in cost of your training, thanks to this thing here. And the maths on that is just 20% extra deduction. So if you've spent 10 grand on training, we look at 20% extra deduction. So you get to claim another $2,000 on your, as the tax deduction, times by 25% equals a 5% overall reduction on the actual cost of your training. So if you spend 10 grand, I was going to stuff this up. So you get a reduction in the net cost of it by $500.
Yeah.
That math adds up. Yeah.
Yeah. Yes, it does. And I think the bit that it's easier to understand as well is kind of like the easiest way to understand is training is on discount by 5%. So if you kind of like if you go and go shopping and you say 20% discount, think of it that way. The training is discounted by 5%. Obviously, it depends on the tax rate, so it's underpinned by the tax rate itself. In our example here, is there's a 5% discount on the training costs.
And when I first heard that, I started like, beauty. We've got someone at work who we a good portion of what they do is actually to organise training and even deliver training to our team. And then I read the fine print, which said it applies to external training courses, not internal or on the job training in Australia. Delivered in Australia or online and delivered by entities registered in Australia. So that's kind of the draft stuff that they've given us at the moment. But unfortunately, if you've got a training team member, we can't go and claim their salary, an extra 20% of it, or that sort of thing. But if you've got team like apprenticeships or like formal training you're doing with your team, then that may be eligible. So do keep that in mind. Again, it's not a game-changing amount. So again, when we talk about trying to save tax, we don't say, just go and buy a car to get the tax benefit. That's just, spending 50 grand to get a tax benefit of maybe, 15 to 20K back. That just doesn't make sense. But if you're already doing it, or if it makes sense for your business in general, then the 5% definitely helps get the business case, so to speak, across the line.
Yeah, and I might add my opinion there. Feelings on it is that it doesn't drive. I don't think it drives people to go out there and go, hey, let's go shopping for some training. I feel like that was the intention. But yeah, we all have our opinions on it. I guess it will help for people who are already doing it. I don't think it's enough to go and do it. It's a bit different. So, but yeah, it's going to help. It's going to help.
Yeah. And maybe there's a similar one coming out as well. So I'll move to the next slide, which is the technology investment boost. This one applies from expenses from budget night until not this June, but next June, 2023. So 1 year less than the training boost. Same turnover range, under 50 mil, and same kind of guideline. So you get to deduct an additional 20% of the expense. Now, there is an annual cap of 100 grand. That's to keep in mind. So if you spend, $1 million on this stuff, you can only get an extra maximum additional deduction of 20 grand anyway. And again, if we do the maths on it, that's ever only going to be a maximum 5 grand benefit, even if you're claiming the full amount. So again, not game changing. And I'm kind of not sure how this one will actually play out, because I read the guidance given so far is it applies to business expenses and depreciation assets that support their digital adoption. So the business's digital adoption, such as, portable payment devices, cybersecurity systems, or subscriptions to cloud-based services. I mean, we spend heaps on subscriptions to cloud-based services. Fantastic. Like, can we just go and put that under this thing? I don't know yet. So the fine print will come out on that, but keep it in mind that we may be able to get a very small bit of assistance with our spend in these areas. So yeah, keep an eye on this one. I think this might actually be eligible for or make a lot of businesses eligible for this one. But again, seriously moving the needle, I don't think so.
Yeah, and I think, adding my opinion on this as well, again, I think a lot of it is to kind of bring it to maybe if it's in the background, now it's in the forefront, at least today it is in the forefront. You go, if you're experiencing, with the previous one, it's about training with your employees. If you're experiencing a bit of a crunch, in retaining people or developing people, this might bring this to the forefront and go, oh yeah, actually, I might get a 5% discount. That's a win. At the same time, I can kill two birds with one stone, train my employees as well. So I think that's where the practical magic really happens. Is it gets you thinking about, what can I actually do to make sure that the skills are retained and developed as well within my business. Same with this technology investment boost. They're really wanting you to start thinking about adopting a more of one of them is cybersecurity. If you don't have that, hey, maybe that's something you start thinking about. We use a lot of cloud software. Cybersecurity is a big thing for our firm. If we didn't think about it before, this is in the forefront. So use that as a bit of a trigger. You get a discount for it, which is great. But if that was part of your many to-do list, and you've been procrastinating on it, maybe this is helping you where you're going to get at least a 5% discount and just get it done, because it has a time limit as well. So they're pushing people to get it done. Something worth mentioning about those two what do we call this? Boosts. Thank you. Those two boosts itself. The way it works is, even if you incur those expenses between last night and the end of this financial year, you will actually get that 20% discount. So how it works is, you might not get it in this tax return when you submit the one that finishes in 30th of June in 3 months time. They'll actually carry that into the next financial year for you, because it just takes a bit of time for them to update their systems for you to be able to allocate some of those expenses. So even if you're already doing it or you're thinking of doing it, what they're encouraging is you get started now. You might not get the deduction this financial year. You'll actually get it in the 2023 financial year instead.
Yeah, perfect. And Cons asked a really good question. Does the 50 mil threshold apply to a group? It absolutely does. So that's the aggregate turnover of a business group, rather than just a single entity, which may be annoying in your case, I'm not sure, but yeah, that is a business group where they'll even look to related ownerships and things like that. There you go. All righty. This one. Get me a little bit like, oh, okay, what's going on here?
Yeah. So with this one, if you have a company running a business and you're prepaying some tax for the current financial year, this is something that we've kind of been waiting for a while. The pay-as-you-go installments is the way that you prepay tax for the current year, and usually it's based on last year's returns that was lodged. Now, seeing that in the last 2 years, last year and this year can be vastly different for a business in terms of performance, and we're still paying tax as if we were trading, as good as last year. So you might be, how this kind of helps here is, it's not necessarily a tax savings, but a cash flow help. So you don't have to prepay as much as you do where businesses or companies can opt into a real-time PAYG installment kind of system and calculation. Now, this is based on your accounting software. So they'll actually look at current year, how are you doing? And then they'll calculate the tax installment you're supposed to be based on the performance of your business currently, not last year. What I like about this is it actually helps you budget your cash flow, plan your cash flow a lot easier. Because right now I'm having conversations with clients talking about, hey, we have to pay 15 grand in installments. Riz, I don't have that 15 grand. This year is really bad. Oh yeah, but the ATO levied that based on last year, you had a cracker year. Oh, okay, well, I'm tied up for cash flow. They start falling behind on the payments, issues come up, and it's just not realistic. Yes, we have the ability to vary it down to a reasonable amount. Already, that's right. And but this is more of a proactive approach. We don't even have to take that step. So they're really realigning that a little bit closer to what your business is actually doing right now, and managing that cash flow is more important than ever right now.
Yeah, I guess the dangerous thing here is it depends on how it's implemented, because it seems to, like, just on the surface level, it seems to rely on the books being perfect and representing taxable profit rather than because I guess when we look at a client's zero file versus their tax return, there's a lot of tax adjustments usually, and so what this may need to somehow consider is the difference between zero's accounting profit or whatever accounting system you use and what ends up as taxable income on the tax return. So Now we've got a heckler who uses Zero. All right.
Doesn't use Zero. Yeah. So Steve, everyone does.
Yeah.
Everyone uses Zero, apart from Steve, I think.
That's it. So yeah, I guess I'm in the unsure if this is actually terribly helpful box. And there's a lot of work that needs to go in on the ATO side, but also the client side, and in terms of like up-to-date books. I just don't know how this is going to be really well implemented, and I don't like. I'd rather go with the whole variation approach if you're struggling with cash flow and profits down, which is already available. You don't need to connect in your accounting software with the ATOs.
Yeah, and I think
tentacles.
Yeah, and I think that's probably the biggest downside is you're actually presenting stuff as you go along to the ATO rather than when you report your tax returns. Who knows what that means? Not trying to fearmonger or anything, but that just means there's a bit more transparency between you and the ATO. Now, my opinion of why this is good is actually it makes you think about tax as you go along, as you make profit each month. Why I like about that is if you think about, let's just think about the top 5 expenses in your business: rent, wages, if it's a cost of goods, the tax bill will be 25% of your profit. It's going to be a massive tax bill. Usually it's an afterthought with taxes, and that's the part that obviously we provide a proactive service here at Inspire that to help you get tax planning done and all that before 30th of June. But even if this is implemented, I think it will be a conversation that you will be well aware of closer to the end, every month rather than at the end of financial as an afterthought. That's what I kind of like about that bit. It's a bit more proactive in thinking about your tax.
Yeah, that's it. And the other good thing, I guess, is the opt-in is the key word there, rather than. But I kind of feel like it's a matter of time. It's like single touch payroll, which we'll talk about shortly. That was an idea, and now it's compulsory in most businesses. So anyway, that's cool. We've got one more in between that. Riz, would you like to share on this little?
Yeah, so this is quite a straightforward one. There's been a lot of COVID support in the last kind of 2 years. So many different grants from so many different states. And if you're from, those different states we started the webinar on today, you can check it out. There's so many different ones. If you don't know about them, I recommend you checking on some of them. New South Wales has a Omicron COVID grant for January if you got impacted. All that stuff. What they're saying right now, it will be non-accessible income, which means that you get more bang for your buck with that grant. You're not then paying, the state's not giving you that money, and then the federal government takes a clip of that. What they're saying is that's all yours for you to grow your business and obviously to sustain it as well. So yeah, payments that are made until 30th of June 2022 will be non-accessible. And here's some of those grants as well. I highly recommend looking into those grants if you haven't yet. You'd be surprised that there's actually quite a bit of help there that you might not know about. And it's just different for different state, obviously.
Beautiful. All righty. Now, single touch payroll. Hey, this is an interesting one for business owners with payroll bills heading over $1 million a year. So single touch payroll data, actually $1 million is at 1.3 mil is Queensland's threshold, but it is lower for other states. So sorry, that's a pretty general statement I made. It depends on your state payroll tax threshold. The thing they've announced is single touch payroll data, so that we're sending literally every pay that we do in our payroll software is to be shared with the state revenue officers, open sharing between federal ATO and state governments for compliance with payroll tax requirements. The spin they put on it, which is, oh yeah, the benefits to you is it pre-fills your payroll tax return, which is great for, and really it is great for admin because it's a pain filling out that form and going back months and months and sharing payroll data. I mean, it's good in a sense where it'll save a bit of admin for you. And I'm not suggesting that people should not register for payroll tax where you're required to, but it's definitely a little bit of that big brother, got an eye in on your accounting like in a huge way. And when we look at the pay-as-you-go installment stuff being connected in, I just think where we're going is closer and closer to maybe what the states use in certain things, where they actually take the pay-as-you-go withholding tax from employees pretty quickly after payment is made to the team, and just that really open data sharing between our accounting software and the ATO and Office of State Revenue. So, it's one to look forward to.
Yeah, just to add a little bit there as well, in personal experience and professional experience, actually, what I've seen is that sometimes you don't even keep track because there's so many taxes, so many rules, so many different things. An amalgamation of all of the rules will actually help streamline a lot of the admin side of things. So, for instance, I think the Corporate Act for companies used to be state-based, and then they turned that into federal. Now the federal government looks after that. Yes, we can argue there's a bit of a big brother thing going on there. I obviously see that, but where it helps is you understand the rules singularly. It streamlines everything so that you're within the box or out of the box. You can see that clearly. Now, in the professional experience I've had is sometimes we don't even realize, and you've had this big growth spurt in your business and you go, oh my gosh, actually I owe back taxes for my payroll tax. We don't, here it makes it a little bit more upfront because then you can keep track of it. Kind of similar to the taxes, you're kind of on top of it before it happens. And then if there's obviously things you need to do to stay compliant, you can meet that head on rather than later down the track. So I think that's where the slight benefit is making sure that we actually stay on top of it. I don't particularly like the payroll tax. I don't understand why it actually exists. It's a tax on a tax for hiring people.
It's an encouragement to hire offshore or interstate.
It's just weird. And there's always been talks about scraping that tax. So we'll see what this actually creates, because if maybe more people getting, hopefully, it's not too bad, but more people getting caught under the payroll tax, means more people will voice out how silly it is at the end of the day. So let's see where we go with this.
Beauty. And our good friend of Inspire, Natasha's just mentioned some other benefits of this as well, which is it benefits in like making sure people are doing the right thing. Is it gives Fair Work enormous insight into how you pay your employees and whether they're being paid correctly for all the entitlements and award wages and things like that. Should be a lot more fluid, which I guess is a good part of that. Sweet. All right. Now that's it for the sort of small business section we've got, and
I think that's where it's light on, right, man? It's kind of like okay,
just another day, right?
Yeah, but I think we've been used to immediate tax deduction. We've been used to the big stuff. And to be honest, I think a lot of the stuff has happened ongoing as well with the last 2 years. For instance, the depreciation temporary full expensing has been extended. We haven't added it. It's not part of the budget, but it was announced earlier in the year where that's actually been extended. I think 2020, Jamie, correct me here, 2023 or 2024. But yeah, that's been extended. So there's things like that that's happened along the lines, but the budget itself was a little bit light on for us.
That's it. Alrighty. So now in the investor box, there wasn't really much in the investor department to consider, and I guess there still is some things to think about. So my opinion is no news is potentially good news here, even in previous elections, and maybe we'll hear it again. Certain parties have suggested to remove refundable franking credits, which is a personally, I think it's a bit of an unfair treatment of how people invest their money. So that's a good thing from a tax perspective, that nothing's been mentioned around that. And then the other changes, which are non-budget, but they're definitely related to this financial year that we're coming into, is the ATO has recently released their position on trust distributions and how that's done within family groups. Now, the rules haven't necessarily been adjusted, but the ATO's position on it feels like it's been heavily adjusted compared to what what do you call it? the standard that's been set in the past was. So if you see the the whole Division 7A is a reference to the Tax Act, but the one they're looking at here is Section 100A. Which is all about trust distributions, and so make sure that if you've got a family trust, discretionary trust, that comes into play in your tax planning with your accountant.
Absolutely.
It's at the forefront of our whole accounting team. We've been working on it for weeks now in terms of our approach, and just making sure we do things in line, but still, trying to get the benefits of using trusts in a family group. So, yeah. And this one we'll go into a bit more detail on our tax planning webinar in actually next Thursday.
Yep. Yeah, I think that's there are certain things we were waiting kind of eagerly to see if there's something that comes out of it. But yeah, we didn't really hear much in that area. Yeah, I think again there might be stuff that gets released even after the budget that we might hear in the next coming months, especially with the S100A stuff. It's a big industry conversation topic right now. If you're an accountant,
that's a nice way to say it. There's a lot of pissed off accountants. That's it. All right, Riz, tell us about this SMSF.
Yeah, so this was actually brought about during the COVID to help people during COVID. If you have a self-managed super fund, or you have a super fund, there's a minimum amount. If you're on a pension phase in your super fund, there's a minimum amount that you need to take out each year. Why is that a bad thing, so to speak? Is that if you take money out of super, usually it's really hard to get it back into super for people who are retired. So you actually want to take it out as slowly as possible, if you can. At least the compulsory amount should be as little as possible, so that you have more freedom in how much you keep in super. What they've said here is that they've reduced. So this is the old rule, the one that was introduced about 2 years ago. They're saying that the minimum requirement for the pension drawdown is reduced, and what they're saying here, we're going to extend that rule essentially, so you don't have to draw down. It was at 50% more than the usual, so it's reduced by 50%. So yeah, that's going to extend all the way to 30th of June 2023. And yeah, there's some rules there. Obviously, minimum drawdowns depend on your age. Usually it's around 4%. Now they're saying, hey, look, you don't have to draw 4%. You can draw down 2%, keep more of your money in super. That gives you a bit of flexibility, rather than having to draw 4% out of super as well. So some people might find that as a big win, because they might not need 4% of $1 million being drawn down. They might only need 2% to live on. They want to leave more of it in super, because it's a great tax environment in there for them. Cool. Again, nothing like, it's like extensions, it's nothing crazy new, but that's worth mentioning as well this year. And you don't have to go back up to 4% for tax planning purposes.
See. Well, and we're going to switch to a bit of Q&A shortly, because that's actually the end of all the bits we felt relevant to share. Before I do that, I'll just mention a couple of things. The first one is, if you do want to sort of see the replays, we post the webinar replays on Facebook and YouTube, and we will actually send out the link to the recording after the webinar today. Thanks, Tay, for posting those links to our socials. So yeah, if you enjoyed it, give us a like on whatever platform you choose. And again, just an invitation, if you do want to have a chat to our team about the budget, how it affects your business, which is probably not a whole lot, or even the tax planning stuff we were speaking about before and what that looks like, then please book in a strategy call. You can do the Zoom one too. So meet an accountant face to face and ask some questions, and even suss out how we work with our clients. You are more than welcome to do that. But I think that's about it for me yapping on and you yapping on. But, but we might switch to a bit of the old Q&A.
Yeah, and if you guys have any questions, feel free to use the either chat or the Q&A button there. This is where, if you have any quick questions that we can help with, yep, let's do it. While we're waiting for that, there was something we were kind of tossing up whether to share this topic or not, but there was something in the budget update as well that was interesting, but it's still quite convoluted in terms of how they're going to apply it. But if you are, if you have a business where you're thinking of issuing employee shares, schemes to your employees, there was a budget announcement that they're going to remove a lot of the red tape that comes around employee share schemes. The problem about employee share, I'm not going to go too much in detail. The problem about it is it's a share, it's a financial product. So the Corporations Act, the boring, essentially says that certain people can issue shares and sell or recommend for someone to buy those shares in the company. So that's where the issue comes in. Is Corporation Act, actually there's some disclosure requirements. There's a lot of stuff that comes, i.e. red tape. So it makes it a lot harder for businesses to actually use what is a really good incentive for employees, to issue shares to them so that they own a part of the business that they're working in. It's such a good incentive, but the red tape usually stops everyone from doing it. It's like, too much, too hard. So what they're looking at is actually getting rid some of the red tape, and also where you can actually increase the value in terms of the shares that you can give to your employees as well. There's limitations before in the Corporations Act. They're trying to get rid of all that. I like it because, again, in the market where retention is key right now, people call it the great resignation. It's an important part of the business where we can use some of this stuff to retain some of those key employees or key members of your team, using that. I love that they're getting rid of the red tape, and a lot of startups rely on it as well, tech startups or any other startups where they don't have cash to pay really skilled employees, or employees that they poached from Apple or from Google that they don't have the money to pay for, but the upswing of the business will be worth a lot for them in the future. So I feel like this ESS will be something that a lot more people will start talking about in the coming years. And it's about time, because in the Silicon Valley in the US, that's what it's literally built on the back of employee share schemes. So I think it's good that we're going into this space as well, where there's more than one way to attract and retain those key team members.
There you go. And thank you, Riz.
Okay.
We were working out what we did there, but in terms of sharing that, it's just, there's such convoluted rules. But we did have another question from Yvonne. Thanks, Jamie, for jumping onto it, but I'll share it for the rest of the people joining. Yvonne asked, how long will the fuel reduction, so the reduction in the fuel excise, be for? And the answer to that is at least 6 months at this stage is the estimate there, which, is half decent, I guess.
Depends on what you do in your business, right? Like if you're a logistics business with many trucks, I think, is that your granddad used to do that? Is that right, Ben?
Yeah, he ran a removalist business. That's it. That wouldn't have been fun.
Yeah, even a small percent of savings will mean a lot to the bottom line. So I think that will make some differences in those companies that use a lot of fuel in their business. I can think of landscapers. I can think of composting businesses. There's so many businesses that will actually gain quite a bit from that.
Yes, beautiful.
Yeah,
all right.
We've still got quite a few people hanging around. I think
they're waiting. They're waiting for the music at the end.
Awesome. Matt's got a question. With regards to the cybersecurity, cloud software, and training discussed earlier, is there any detail to training courses for upskilling staff? Great question. The honest truth is it's quite on the surface right now. We don't know in detail what would be eligible as an expense of what you can do there. But the answer, the question that you have is any detail to training courses for upskilling staff. I predict there will be. Here's my prediction. I think if you have an external provider upskilling your staff, that cost itself, you'll get, in our example, a 5% discount on that.
And maybe like I'd say with fairly good certainty that things like if you're paying for certificate 3, 4s, diplomas, apprenticeships through registered training organisations, all that stuff should be covered. We're kind of waiting to work out if things like CPD, like continual professional development, whatever they call that, for accountants, for instance, is included in it. Bits and pieces like that, or even like, consultants that you get to train your team, like they're not kind of RTOs, but if they're training the team in a formal way, will that count? So that's kind of where we're waiting to get some clarity there. It's not quite in-house if you're paying an external consultant to come and train your team on, let's say, sales skills. But, they're usually rather expensive. So, yeah.
What I imagine is that usually when it's a hot topic like this, you'll see RTOs actually advertising that. Kind of like donations that are tax deductible. You always see it. Oh, donations are tax deductible above $5. You'll see that the RTO say, "Oh, you get a 5% discount." Or they might not say it that way, but they'll say, "Oh, we include." I predict all of this will come out because it is in a span of kind of until, I think there's 2 different dates, but 2023, 2024. So people will start developing stuff to make it clear for everyone. But it is exciting if you do have any expenses right now. Again, it's not clear, but I think we'll hear not next month, but in the next few days of what's actually eligible expenses. And there's nothing stopping you to claim that in this financial year, but you get that extra 20% deduction next financial year instead.
Beautiful. All righty. Well, we might finish that up there. And thanks for everyone who's joined in, and I hope that's been helpful. It might not be, the best budget outcome we've ever seen, but there's a few little bits and pieces in there.
Yeah, and I think that if I could kind of get the some winning strategies for you guys, it would be next week when we do our tax planning webinar. If you guys are watching this and going, okay, cool, what else can we do? Go to that webinar, register for it. I think, Tay, if we can repost that link right now, everyone can just register that link. We'll see you guys next week. It will be really about what you can do in the next 30 days to make sure that you save as much as possible legally in tax between now and 30 June. There's going to be conversations around that S100A compliance as well. It's going to be a massive one. So tune in, definitely check it out, register, and we'll see you guys next week.
Beautiful. All righty.